Entrepreneurs, if you are serious about building your business, then you need to be taking the money that you're making from your business and investing it back into your business, as opposed to taking that money and investing it in stocks and real estate, because none of those things are going to help build your business. But then the question is, when do you diversify? And when do you start taking some of this money and enjoying it for yourself? And the reality is, you're going to have to find where along the spectrum is right for you. Sam Walton, in his book, Made in America, the founder of Walmart, talks about this, which is very interesting. He says that when he was building Walmart, he wasn't investing his money into stocks. He wasn't investing his money in other places. He invested his money into one place. And the one place where he invested his money was Walmart. He didn't want to diversify. He put all of his eggs in one basket, which is his own company, which allowed him to grow his company. Now, did he take a risk? Absolutely. If Walmart went bankrupt, he would have lost everything. But that was what was important for him. Now, do you have to be as extreme as him? No, you don't have to build a multi-billion-dollar company, but you got to figure out where along the spectrum do you want to be. And this is where you have to figure out now, as you start to make money, when do you put it back into the business? When do you pull some money out? And when do you invest this money in other places like stocks and real estate? Because when you're building your business, there's no limit to the types of returns that you can see, right? When you put your money into the stock market, or when you put your money into the real estate market, you're generally trying to get a 7 to 10% return on your money. That is the average return on stocks and real estate over the last century. So when you take your money out of your business and now you put it into stocks or real estate, now you're getting a little bit of a return, hopefully. But when you take that money and you put it back into the business, now you're not trying to get a 7 to 10% return on your money. I mean, even late stage startups are still trying to grow by 20% or more. But if you're an early stage company that has a lot of room to grow, now you could be growing by 50%, 100%, 200%, maybe even 2,000% a year in the early stages, because you take the money and you're investing it smartly back into your company. Now, there's also a risk here, because when you take the money and put it back into your company, sometimes you're going to lose. When I was investing money into my blog, because I wanted to build the Minority Mindset blog, I wanted to turn it into this self-funneling revenue stream where, okay, yeah, we can capture the Google searches, and people search these financial terms on Google, that my blog will show up, and then you're going to get all these amazing articles, and that's going to generate me money. Well, guess what? I probably put like $500,000 into that blog over the course of 18 months or so of hiring the smart people, hiring consultants and doing it. I wasn't putting my time into it, but I hired people to help take care of it, and it was a complete flop. Sometimes you're going to lose money. All the $500,000 went down the drain, and I'm never going to see that money again. Now, yeah, that sucked, and that's a risk you take. But if you keep investing back into your company and you stay consistent with it, sometimes you're also going to make smart investments which will grow into something way bigger. And that's where now you have to find what's most important for you right now. Now, if you're looking for general rules of thumb, look, if your business is not making $500,000 a year, you should not be investing your money into stocks. You should not be investing your money into real estate. Right now, your money needs to be going back into the business to learn how to grow the business, to learn how to scale the business, to learn how to sell more products, to learn how to market, to learn how to get more customers. Because right now, in that stage, you have to get more money. Once you get to $1 million and more, now you have the potential to kind of figure out where and which direction do you want to go. Because now you can have the cash flow to, one, prove your concept. Once you're making $1 million a year, you can kind of prove that, okay, I have found something of value. And that's where then you can decide, do you want to continue building this business into something a whole lot bigger, or do you want to start taking your foot a little bit off of the gas pedal, take some of this money out for yourself, and take some of this money out to invest it into other assets that we have some diversification. And now you can also start deciding, well, how much salary are you paying yourself? And now out of the salary, how much are you going to be investing as well? Like what I do here, I'll give you just my personal example. I'm not telling you what to do. I don't recommend what I do to anybody. I'm just going to tell you what I do. When I make money in my company, meaning when I generate money from my YouTube channel or from whatever I do, my speaking gigs, I don't take that money and just put it in my personal bank account. If I go out and I charge $20,000 for a speaking gig, that $20,000 goes into the business bank account, and then I pay myself a salary out of that. I pay myself 20%. That is my commission. I pay myself, I'm on commission in my own company. I pay myself 20% of the revenue that I generate. So if I generate $20,000, that means I will pay myself $4,000. The other $16,000 stays in the business, which then goes back into the business to be reinvested. Now, when I get paid my salary, the majority of my salary is being passively invested. So I get my salary, I get a salary once a month, which is a commission off of the revenue that I get from like my YouTube ads and other things that I do. I take the salary. Now, most of this gets passively invested. Where does it get passively invested? It gets invested into places like the stock market. It gets passively invested into physical gold. Some of it gets passively invested into places like cryptocurrency. And then if I have a real estate opportunity, I will find money to do that as well, wherever that might be, because I also have my savings there as well. But the bulk of my money is being invested back into the business. Now, you might be thinking, but Jaspreet, then how do you go out and fund a big lifestyle? Well, I don't spend a lot of money. Most of the expenses that I have are write-offs. When I go and travel, these are for business purposes, meaning they come out of the business account. When I go out to eat, most of the times they're write-offs because I'm typically meeting with somebody and having a business dinner. Because guess what? A business dinner is a write-off. Me sitting by myself eating at a restaurant is not a write-off. So I want to make sure I have as many meals as possible with business people because that then becomes a tax deduction. I don't have an expensive car. I don't have expensive purchases. I don't have fancy watches. I don't have fancy clothes. So my personal expenses are very low. And yeah, I have business expenses, but that's where now I am really focused right now on building. Right? I'm working to build Briefs Media, which is my newsletter company. That's where my focus, my time, my energy, and my money is going. I do have my passive investments, and I kind of got started in a unique way where I started by investing. I started by working to buy rental properties. That was like the name of the game for me for a decade, where I learned about real estate investing pretty much on accident. And then I did whatever I could to make money to buy rental properties. I wasn't spending money on other things. I wasn't going out and blowing money on vacations. I wasn't going out and buying nice things. I was making money from all of my entrepreneurial ventures, whether it was event planning, whether it was wholesaling real estate, whether it was selling real estate as a licensed real estate salesperson, whether it was running my other businesses. I made money and I bought as many rental properties as possible to build a real estate rental portfolio, which also pays me with cash flow. And that cash flow is things that I will spend because this is passive cash flow, or generally passive cash flow. I still have to manage my portfolio and my managers, but generally passive. And then after doing that was when I really got more into business, learning about scalable businesses. So I kind of got into things a little bit backwards, but that was just what worked for me. So now my focus is building that active business. And this is where you have to figure out as an entrepreneur, what is the most important thing for you? Now, because I got involved with real estate early and because I got involved in investing in the financial education side early, I love the game of putting money to work. I love the game of investing. It's fun for me. So yeah, I still do that. I'm not actively buying stocks and real estate the way that I used to. Back in the day, it was, I made money, I'm going to go out and buy a rental property. I'm going to go out and look for an apartment complex. I'm going to go out and look for stocks to buy. That was where most of my time was going. Now, it's more of if I see a great opportunity, I will go out and take it. But most of my time is being spent taking the money, putting it back into the business and working to grow the business. Is it risky? Absolutely. Briefs Media could go bankrupt. If it goes bankrupt, I will lose all the money that I put into the company. I will lose all the time that I put into it. And it would be a big, loss for me. But that's the risk that I'm willing to take. And now you as an entrepreneur got to find the right balance for you. There's no secret sauce to how you do this. There's no secret percentage of how you do this. Some people, Sam Walton, went 100% into his company. I'm not there. You got to find where is the right percentage for you. Is it 20%, 50%, 70%? What is that right percentage? And at what point then are you okay pulling your foot off of the gas pedal? And that's where you got to figure out now as an entrepreneur, when do you ease off of the gas and when are you comfortable? And if you can build a business big enough, well, you could also hire somebody else to take your spot if you feel like you don't have that same drive and commitment to keep taking it further. And that's where you got to figure out now as an entrepreneur, as a CEO, as a person running the company, where it is that you want to be and how can you scale the business the way that's going to be best for you. Now, if you are an entrepreneur, we have a free newsletter for entrepreneurs called Business Briefs, where my team is working to break down the latest business trends. That way you can stay on the cutting edge of what's happening in the business world. We cover things like the business trends, innovation trends, funding trends. That way you can understand what's happening in the entrepreneur and business world and spend more of your time just running your business. These newsletters are completely free. So if you want to join Business Briefs, you can go to briefs.co/business. That's briefs.co/business. And I also got the link for you down in the description below. There's been a lot of talk recently about the real and root cause of inflation, where you've had a lot of media articles saying that corporate greed is what's causing inflation, and it's the reason why inflation is still here, and it's the reason why inflation is not going down. That corporate greed, wanting to maximize their profits, is why we are seeing